Can I sell my own appreciated real estate into my own fund? Like everything, the answer is always yes. You can always do anything that you want as long as you disclose it to your investors. So you can buy your property at whatever price you want. You can sell it into your deal at whatever price you want. You just have to tell the investors exactly what you're doing. And by the way, you need to make sure your attorneys know so that they can give you counsel on the right way to do it. But there are lots of other issues that you need to think about. This is not cut and dry. It's not just go to the attorney, ask them a question. People who know me know that I'm all about raising capital. And in order to succeed in raising capital, there's a couple of big do's and don'ts. And one of the big don'ts is making investors feel like you're getting a better deal than they are. And if they feel that, they're going to push back and they're going to stop right in their tracks and they're not going to let you move forward. So here's a couple of issues. If you raise, let's say, a couple $1 million and you contribute appreciated real estate that has gone up since you bought it, and you can document the exact price that you paid, whatever you did, or sat in your inventory, whatever it was, and it went up, let's say, $1 million. So you're going to take $1 million off the table. So you're not just transferring the property into the fund. You now want to sell it into the fund, which is a little different than transferring it into the fund. So you're going to sell it to the fund. You're going to contribute it. Maybe it comes with a mortgage and the price got up. So the fund is going to take over the mortgage and you're going to take, let's say, the appreciation of $1 million off the top. You properly disclose it. You show all the escrow papers, the mortgage papers. You show everything that happened. It's all done just perfectly, and the attorneys bless the transaction. The accountants then structure the taxes and make sure that everything is done just right. So everything now is perfectly in order. But you now raise $2 million and you take $1 million off the table. A lot of investors are going to have a real problem with that. They don't have a problem that you're making $1 million. What they have a problem with is that you're taking their money off the table. See, when investors give you capital, they want that capital to go to add value to the property. They want their investment to add value to the transaction so that the transaction can be better for everyone. And when you take $2 million and you take half that money back to yourself as profit, then really only 50% of the money that they put into the deal is really ever going to go to work. And that's really not the goal for most investors. Most investors want all of their money working, or as much of the money as they can to be working. And the way that you've organized this, it really doesn't work. So instead, what you might want to do is you might say, listen, I'm going to transfer the property in at $1 million gain, which if you can document it is entirely fair. And the deal is going to pick up the mortgage, that's fine. But you're going to say, instead of taking the $1 million of equity out, I want to convert that into ownership in the transaction. Now, keep in mind, most operating agreements that most attorneys draw up, they can't do it because you can't transfer in real property and take shares. Most operating agreements work where there are two classes of shares, one for the cash investors, one for the promoter. Well, you're not a cash investor and you want something different than your promoter interest because you're going to get that anyway. So how do you make sense of this kind of transaction? Well, our operating agreement has 4 classes of shares because there are 3 ways that investors can put in value, not just one, which is cash. So most operating agreements is investors put in cash, the promoter puts in services. So those are 2 classes. But there's 2 other things that investors can put in that are not accounted for in a traditional, simple structure that most attorneys draw up. The second one is assets other than cash. So what if somebody wants to trade in an apartment building? They want to put in a building. One of the things that we do, we have a program, it's called Shares for Heirs. And if somebody wants to put in shares and give them to their kids, because think about this situation. Grandma and grandpa work their whole life, they buy a building, they trade it using 1031s, they're moving the assets, and they grow it to be pretty big. And they've got 3 kids and a bunch of grandkids underneath that. But the kids don't get along, they fight, they scream, they don't like each other. You know, there's a situation where grandma and grandpa want to take care of these kids that don't get along, and they know that if they give them the building, that the second that they die, that their kids are just going to sell the building and squander away all the money. So one of the things that you can do is if you work with, let's say, estate attorneys or otherwise, one of the things that we get some of our guys to do is we build these special kinds of structures that allow them to move the asset into the fund and then give the grandparents shares that they can then give to their heirs. And then the kids get the cash flow, but they don't get the building. The building then belongs to your fund. And they get actually some protection. They get some diversification with a bunch of other real estate in different parts of the country or however you're organized. So in a certain way, it's better for the family, not only because the kids might squander all the money and they really want the kids to have the cash flow, but also because there's some diversification against assets, geography, and some other things. So if you want to transfer in a piece of land or some other asset, you have to have another class of shares, like our class of shares, where you can take assets other than cash into your fund. And the final asset class that we build in, the fourth class, is called services. Let's say an architect wants to do some work for you, and you say, you know, we have the cash to pay you, but we really want you on the same side of the table as everybody else who's in the deal. So we'll give you 50% in cash and 50% in these compensation shares that we use, where they get a special class of shares that are presently not taxable. And there's a special arrangement that we have for that too. So anyway, long and short is there's a lot of ways to do what you want to do when you want to transfer in assets. I wouldn't do it for cash. I would prefer that you did it and take equity in the transaction instead. That bolsters your voting percentages. It documents to the investors that you're really solidly in the deal. You're on the same side of the table as them, and it looks better to everybody. That's the way that you make a good transaction. That's the way that you raise a lot of capital and you build goodwill. So those things all being put together, this is a great business. Now go out and stake your claim.